Hello, I'm Hunsley from Livewire Markets, and welcome to Views from the Top. Our guest today is Ron Temple, Chief Market Strategist at Lazard. Ron has more than 30 years experience in the markets, 20 of those years plus at Lazard, first starting as an equity analyst, now of course Chief Market Strategist, as I say. It is great to see you again out here from New York, Ron.
Great to be here, thanks.
So, can I start with your base case macro view for the US, essentially calling for immaculate disinflation, leading on to orderly rate cuts? It's Goldilocks, everyone's happy. So what could upset that view?
Feels really dangerous, doesn't it? Yeah. I mean, I do think this has played out as well as you could possibly hope. I mean, if you told me 2 years ago that the Fed was going to raise rates 525 basis points, shrink its balance sheet $1.4 trillion, I would immediately be thinking, how bad is the recession? In hindsight, what I got wrong is the American consumer came into this rate hiking cycle with more cash on their balance sheet than any prior cycle we've ever seen, in part because the US had a $5.3 trillion fiscal stimulus trajectory, or I guess a total of $5.3 trillion over the 2 years of the pandemic. And keep in mind, by the way, for context, there was only $10.8 trillion of fiscal stimulus globally. So 4% of the world's population got half that stimulus. So whenever rates started going up, when inflation surged, the consumer was sitting on a lot of cash and they made it through this downturn. Now, when I think about the year ahead, a lot of those excess savings have been depleted, especially when you go down to, say, the bottom 40 to 60% of the population by income. So their one risk factor is, do we start to see more pain in the corporate sector? Even though I think the Fed will cut rates 100 basis points by the end of the year, that still means rates are above 4% on Fed funds. It doesn't necessarily mean long-term rates come down, so you could see some more pressure on the corporate side. That could lead to more layoffs, and if consumers don't have jobs, they don't spend, that could be the weakness. That said, my base case is we're going to have a pretty good year. If we look at growth expectations, the consensus is 1.5% real GDP for 2024. I think the US actually could end up doing better than that. Maybe we could print a 2%. That's roughly in line with trend. And by the way, the Fed would be cutting rates despite the strong economy because inflation has come down much faster than expected. One last anecdote, if you look at the last 6 months, the second half of 2023, core PCE, the Personal Consumption Expenditure Index, that's the Fed's preferred inflation gauge, was at below 2%. So effectively, they're already back to target based on that metric. Fed will be cutting rates, good economy, great labor market. It's a good story. It is somewhat Goldilocks, which is very uncomfortable to say.
Yeah, well, I mean, it's a good story at that surface level. I've got to ask, because now you mentioned you thought of 100 basis points worth of rate cuts. Do you have an idea, an inkling, when do you think that will start, and how much does it matter when markets are pricing in when it starts or not?
I'm glad you added that last part. I mean, I'm thinking the May 1st meeting is likely the first meeting. Yeah. And after the most recent FOMC, Jay Powell was very explicit that March should not be the base case.
We're not considering March, I think is what he said.
And then we got the labor report on Friday last week with 353,000 new jobs in the month of January, nearly double the market expectations. Prior months revised higher. The economy is still looking too strong for the Fed to basically, pull the trigger and cut rates so early as March. May might even be a little bit of a toss-up. The market is pricing pretty much 100% chance of May. And so I think that's right. Does it matter if it's June versus May? Not really. What really matters is how much do they cut after the first cut, how quickly. And again, I think the market might be a little ahead of itself. Markets are pricing about 125 basis points through year end. I think it's 100. I think we get another 100 the next year. But a key divergence for me versus what the market is implying, I think the Fed cuts those 200 basis points. Maybe we get 225, but I think that's probably the end of the easing cycle because, again, inflation would be down. They would have dealt with their maximum employment mandate. The last thing the Fed wants to do is get down to 1% or 0% on rates absent some economic crisis. So I think that's kind of the end of the rate cutting story in the US.
Let's come to markets now. You've argued in the past, I think it might have been the first time we did an interview together in person, you've argued in the past that the S&P 500 could fall by double digits on the back of earnings downgrades. I mean, we haven't seen the former really play out, just given even the S&P 500 has climbed something like 20% since those October 2023 lows. But can I ask about that second part? Do you still expect to see these earnings downgrades, and maybe when do you expect them to arrive as well?
Well, I appreciate you calling out what I got wrong. So I did get that wrong, and I think it's one of those key lessons of having been an investor for decades is recognizing what you can and cannot predict with high confidence and moving on when you get it wrong. And what I'd been thinking was that recession risk was quite high last year. Clearly ended up not being the case, with real GDP being materially stronger than almost any economist had forecast. And I also thought there would be more margin pressure on companies because prices were going up, and if the economy were weakening, your ability to pass through those price increases would be impaired and your margins would compress. Clearly that didn't play out fully. And so I think that story's behind us. When I look at the year or two ahead, I don't see a reason to think you're going to have that margin pressure anymore. If anything, you're going to have a benefit from lower interest expense, lifting kind of more levered companies' outlooks. And I do think a decent economy is going to be a good backdrop. What's going to be more interesting to me is where the earnings growth occurs in the market, because for the last year or two, almost all of the earnings growth has been in the Magnificent Seven, with the rest of the market having very low earnings growth. So at the headline level, the market grew earnings. The S&P 493 actually was close to zero earnings growth.
Yeah, okay. Well, let's come to that then. Is the US equity market priced for perfection?
No. Easy answer. I mean, if I look at the market, there are 7 stocks everyone knows about that are priced at about 30 times forward earnings. The rest of the market is trading at around 18 times forward. Taken a different way, cap-weighted S&P 500 is at 21 times earnings. The equal-weighted is at 17 times. And so what we've seen is an increase in valuation in a very narrow part of the market, largely on the back of artificial intelligence, AI enthusiasm, some of which is definitely warranted. The big question around those 7 stocks is how high will the cash flows go and how quickly? And that's going to determine if they're overvalued or undervalued or fairly valued. What gets me excited about the US market is that other 493 stocks have actually derated over the last 2 years. I said earnings growth has been very low. I believe the cumulative earnings growth from the beginning of 2022 to the beginning of 2024 for the S&P 493 is 5%, just under 5%. So they've had some earnings growth, the PE's gone down. And the way I think about it is the only way the AI story can prove to be as good as many people think it will be is if it leads other companies to increase productivity and profitability by using AI. So the only way the 7 stocks can keep working is if the other 493 stocks get some benefit from this, and that's going to show up in earnings. And I think there are a lot of stocks that have been left behind in this market rally, and this is a great chance for people to basically move away from the benchmark, take some real active risk against those indices, and profit over the next couple of years. It doesn't mean they should short the Magnificent Seven, by the way. Some of those stocks may well still have upside, but there are a lot of other stocks to be looking at as well.
All right, let's step outside the US now, because I know that the Lazard team has been bullish on other markets. I think of emerging markets. Japan, I know, is an interesting place for your teams. What markets, asset classes, sectors, where is attracting the most interest to your team?
To me, the most attractive market globally at this point may well be emerging markets. And this is a complicated little dance here.
Yeah.
I think in EM, what's really exciting to me are a few factors. Number one, there's a macro growth gap that's widening out in favor of emerging markets over developed markets. Yes, I think the US will have decent growth this year, but I was just saying before, Europe might be 50 basis points, Japan hopefully will be 100 basis points. These aren't big numbers. Emerging market growth is already picking up and will accelerate, in my view, in 2024, because once the Fed and the ECB start cutting rates, I think you're going to see some quite aggressive rate cuts in emerging market central banks lifting that growth. So macro growth divide widening. Number two, if you look at companies in EM outside China and outside Argentina, which is very specific, what we've seen over the last few years is an improving trend of returns on capital. So rising returns on invested capital historically are a good indicator that share prices should outperform. Number three, outside of China, we've got a lot of capital moving around to EM. If you look at foreign direct investment into China, the third quarter was the first negative quarter in decades. That capital is not going to the US and Europe, in my view. It's going to other emerging markets like India, Indonesia, Thailand, Mexico. And so I think you've got a geopolitical play of money moving around EM. And then finally, it's trading at 12 times forward earnings versus 21 for the cap-weighted S&P. A 9 multiple discount is an enormous discount. Now, to me, valuation alone isn't enough. But with all of these factors taken together, I think there's a pretty exciting story there. And I do think in Japan, it's a totally different story. The corporate governance reforms are moving the needle on capital management. It was a year ago when the Tokyo Stock Exchange announced companies would have to announce publicly what their capital action plans are. 50% of the companies that are required to do that have done so far, or in the process of doing it. You've got a lot more companies that are going to come. And I've also seen in the last month, the TSE announced that in March of 2025, every company on the premier kind of listing will be required to issue their financials in English and Japanese simultaneously going forward. Only 40% of companies have done that to date. I think what's exciting there, they're trying to pull global capital into this market, and global investors demand higher returns on capital. Higher returns on capital typically make stocks work.
Yeah, the Japanese making hay while the sun shines, maybe. You mentioned China, you mentioned valuations. I'm glad you did, because we've got the CSI 300 sitting at something like 2019 low. Sentiment has been so beaten up. I think I heard it said in the financial press not too long ago, how much more selling is there to come out of the Chinese stock market? Is now the time to be picking up bargains in the Chinese equity market, or do you say let a little more of the dust settle?
I'm glad you asked this question, because part of why I said this is a complicated dance about EM is people are so negative about China. And I'm actually negative on the Chinese economic outlook. I think these housing issues are going to take 2 to 3 more years easily to resolve. Local government financing, we need structural reforms in China. There are a lot of issues on the economic front. But the Hang Seng is trading at something on the order of 8 times forward earnings. MSCI China trading at maybe 9 times forward earnings. These valuations are so cheap that they've embedded a lot of the downsides. So I actually do think now is a good time to be investing capital into Chinese equities, but I think of it as more of a trade. I mean, you could easily see this market up 20, 25%, still be at 10 times earnings. Maybe that's when you want to take that money out. So to me, that's why you want to invest in emerging markets, including China, and have your manager have that flexibility to add capital and take capital out where necessary. And I think right now is a good time to be putting capital in.
All right, so that's equities. Let's turn to bonds, because the action in the bond market over the last 12, 18 months has been remarkable. 5% on a 10-year bond in October, fell to just below 4. We're back at 4. How do you pass the moves in the bond market in terms of your valuation strategy for equities, for other assets?
Well, first I'll say at 5% on the US 10-year, I thought that was fair value for the first time, and I was excited to extend duration and lock in some yield. Yep. And importantly, the reason I say that is BAA corporate bonds in the US, when the 10-year hit 5, were at 680, 690. Yep. So if you think about it, that's a pretty attractive return in terms of taking down your volatility by 2/3 relative to equities and getting a good return. At 4% on the US 10-year, I'm not excited about extending duration. In fact, I think you probably want to be short duration at this point. And my view on this is we're going to see Fed funds rates come down by a couple hundred basis points over the next 2 years. I don't think the 10-year yield is going to come down very much. And this, by the way, takes me to a totally different topic, which is just deficits. If I look at the magnitude of the US federal deficit, the Congressional Budget Office forecast, if you adjust it for the likely outcome of personal tax cut extensions at the end of 2025, the US is likely to have deficits every year for the next decade of at least 6% of GDP. This is an unsustainable fiscal trajectory. I mean, that's the most diplomatic way to say it. I think long rates are going to be pressured higher, and that means higher discount rates for equities, which does put a lid on how high valuation multiples can go for equities. And so, they all do connect back together. I don't know that I see us getting to 5% on the US 10-year in the next 3 to 6 months, but over the next 2 to 3 years, I think we could easily be back at 5% if the economy is doing well, deficits are still high, and that insatiable demand to issue more debt, or supply of debt, I should say, basically, you've got to find someone to buy it, and you've got to pay a high enough yield. So I think that will put a lid on stocks, and the upside to equities really has to come from earnings growth.
I'm glad you mentioned deficits there, because it does lead to a set of questions I want to ask about geopolitics. I know that Lazard has an in-house geopolitics team, and I imagine they've been very busy over the last 12 months. You've got the conflict in Ukraine, you've got the conflict in the Middle East, you've got all the elections taking place around the world, including in your neck of the woods there in the United States. How important is geopolitical risk now to your investment strategy?
I think geopolitics have never been more important than they are today. I mean, and by the way, if you think back, say 40, 50 years ago, even 10 years ago to some degree, geopolitics were the subject for cocktail chatter. I mean, think about for a board. Like if a company's board was meeting the night before at the dinner, maybe you talk about geopolitics. When you went in the boardroom, you talked about company operations. To me, those are inextricably linked at this point. If you think about how big China is in the global economy, I believe China exported in 2022 $3.7 trillion of goods to the world. You can't de-link from that. And so for companies, they have to think about their supply chains, they have to think about their customer bases. Geopolitics are part of business now. And so that combined with all of the different issues you've raised, Ukraine, Israel, Hamas, China tensions with the West, this is something I think that is very important. And by the way, not only in the case where there's kinetic warfare, I do think investors really should be thinking about how this can affect company profitability. And as you just mentioned, the US election, even in the last week, the presumptive Republican nominee, Donald Trump, has talked about potentially imposing tariffs of over 60% on exports from China to the US. That affects inflation, it affects interest rates, it affects equity valuations and profitability. So I think you cannot ignore these issues like you could in the past. And what's really important is having some kind of systematic framework for thinking about it in an objective, unemotional way.
Ron, the series is called Views from the Top, so I thought we'd finish with this question. What is one thing you've become privy to that you wouldn't have realized or had access to if it weren't for the position that you're in today and all the experience you've had up until the position you're in today? Indeed, do you have a view from the top?
Well, it's always uncomfortable saying a view from the top, but I'll say a view from my seat.
Sure.
So I guess when I think about it, geopolitics is what comes to mind first. Partly what I just said of, it's not the cocktail chatter anymore. But I think it's changing how we have to approach investing. And I think, again, historically, I think you've probably been rewarded by ignoring geopolitics, right? I think for investors, what's really important here is trying to, again, create frameworks and think about maybe having thought experiences. One anecdote here. Vis-a-vis China and the West, maybe one thought experiment should be trying to sit down and identify what would be the milestones that would tell you you should be removing capital from China, and what would be the milestones that would say you should be putting more capital into China. And my point on the first part about removing capital is, how do you avoid being the frog in the boiling pot? How will you know when the hot pot is heating up and you need to start peeling exposure back? And then thinking again to the next level of, if I am taking exposure back, is it liquid or illiquid assets? Is it in the debt side or is it in the equity side? Where would I benefit the most by acting? And having a game plan. And I do think, I primarily think of that in the context of a China situation, but the Middle East is a very dangerous place. How would you know if you might want more exposure to oil because of a potential broadening or escalation of the Middle East crisis? How would you know what you would want to do if Russia conquers Ukraine and doesn't stop with Ukraine? And so I do think we have to think about these questions. They're uncomfortable, they're not pleasant. And then, by the way, lest it all sound negative, we should also think about which countries are going to benefit from these tensions as capital moves. Is India a great place to put incremental capital, or is Thailand? India is not cheap. A lot of people are excited about India. Could Mexico be that place? And so I think it's developing that framework. It's something we're happy to help people with. I think we have a great team working on these topics, but it's definitely something you cannot ignore. And regardless of how you approach it or who helps you, I think it should be front of mind for people in investment roles.
Ron, you have given us a lot to think about. I think it's the third time we've chatted. Hopefully it's not too long before the fourth time. Thanks for joining us from Lazard.
Thank you. Pleasure to be here.
And thank you for joining us here for Livewire and Views from the Top. If you enjoyed that, don't forget to subscribe to our YouTube channel, as well as to both websites, Livewire and Market Index. Thanks for watching.